Hello, everybody. Firstly, I'd just like to welcome you to this webinar where we'll be talking about the Bank of England Monetary Policy Meeting and the potential trading opportunities that will come up as a result. My name is Sasha and I'm a financial analyst from the research department at Fortrade. If you have any questions, I will do my best to answer them, or please call us and ask to speak to a senior account manager who'll be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure that you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. Now, a special code will appear on your screen during the webinar, and I will repeat this special code at the end of the webinar that you can use to take advantage of our special offer. Be aware that this offer will expire in 24 hours and that this new offer applies to all of you, not just second-time depositors. So please stick around. Make a deposit within the next 24 hours and you can receive a balance bonus. If you deposit €1,000, you will receive a 2% balance bonus. If you deposit €2,500, you will receive a 4% balance bonus. Deposit €5,000 and receive a 5% balance bonus. Deposit from $5,000 to $15,000 and your overnight interest rate will be covered for 1 month. Deposit $15,001 to $25,000 and your overnight interest rate will be covered for 2 months. Deposit more than $25,000 and your interest rate will be covered for 3 months. So as I've said already, a special code will appear on your screen that I will repeat towards the end of the webinar. And so on to market opportunities. In case you don't know, a market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple to understand opportunity to trade in the markets. We select an instrument such as gold or a currency pair and tell you our very best estimate on its price direction so that you can trade on it if you want to. Market opportunities are provided by the research department, that's us, on a daily basis, according to market conditions. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point, support, and resistance levels. Now, here is an example of a market opportunity. You can see fundamental analysis on what's going on with the pound-dollar currency pair. Below, you can see some geopolitical events that can influence the currency pair. It's important to look at the pivot point, which is encircled on the center left-hand side of the screen, on which the calculations are based. If the price reaches this level that you can see here, this shows the right moment in our estimation to come in and open a trading position if you decide to. You can see that this is a weekly market opportunity, although we also have regular daily trading opportunities. You can see the trend direction here, which is up. Although it's important that you know how to use the stop loss and take profit options. You have support and resistance levels here. At those points, you can put a stop loss and take profit. And over on the top right-hand side, you have calculations. If you close the position using take profit, you can expect the kinds of profits in green. If the price is going against you, you can potentially have a loss of this amount in red. Support 1, 2, and 3. The pivot point is the starting price for opening a trading position. The support and resistance levels are for daily, weekly, or monthly terms. Finally, profit and loss calculations are based on a one-lot trading volume. So in this webinar, as you can see here, I'll be talking about a number of topics, but we shall start with the Bank of England. The Bank of England is the second oldest central bank in the world and was privately owned by stockholders until it was nationalized in 1946. Stable prices and confidence in the currency are the two main criteria set by the government by the bank. Stable prices are kept in place by the bank meeting when meeting the government's inflation target. So the Bank of England was given independence from political control some 20 years ago and the right to set interest rates. The bank has a monetary policy institute with 9 members of its monetary policy committee setting interest rates. That's changing the cost of borrowing. Although committee members are free to set interest rates according to their expertise, the British Treasury has powers to give orders to the committee in the public interest, although this only happens in extreme economic circumstances. The 9 members are tasked with getting as close as possible to the government's inflation target. Before its independence, officials in the Treasury who were not independent of the government set interest rates. The Bank of England has been accused of being politically partisan. Most recently, before, during, and after the referendum campaign on British membership of the European Union. Bank Governor Mark Carney was criticised by senior politicians and the media as being biased against Brexit. He was accused of abusing his function to support the Conservative government's pro-EU position at the time, to influence the referendum decision. It's true that Carney had warned that Brexit could hit the economy and cause instability, but this wasn't an uncommon view among economists. Carney rejected the accusation, saying his view represented the Bank of England and he had not come under any pressure from politicians to support one side or the other. So, the Monetary Policy Committee. The MPC is responsible for formulating the UK's monetary policy. Its committee meets 8 times a year to decide the interest rate and to direct the government's monetary policy. The committee has 9 members, including Governor Carney. The main aim of the committee is to keep inflation close to the government's target of 2%. And apart from setting of interest rates, the other main monetary policy measure used by the bank has been quantitative easing through its asset purchase facility. In plain English, QE is the Bank of England printing money to buy government bonds. The idea is to boost the economy by increasing liquidity. The UK's current or most recent economic performance. In the first quarter of 2018, year-on-year UK GDP growth was at 1.2%, a figure that was below the expectations of 1.4%. Inflation has come down from last year's peak at 3.1% and is now at 2.5%. However, the slowdown in inflation has economists worried that interest rates could reduce economic activity in the UK, even though the central bank's target inflation is 2%. High inflation was a problem, which is why the Bank of England raised interest rates last year and intended further hikes this year. I'll return to this in a moment. Unemployment is currently one of the few positive indicators at 4.2%. This is the lowest level of unemployment in the UK for over 40 years. But there is debate on how positive this is on the overall economy, since wage growth remains stubbornly low. In January, the IMF downgraded its UK annual growth forecast for 2019 from 1.6 to 1.5%, citing concerns over Brexit uncertainty. So, what can we expect from the Monetary Policy Committee meeting coming up? When the MPC meets on May the 10th, it's now expected that rates will remain unchanged at 0.5%. It had been expected that the bank would hike interest rates by 0.25 percentage point only a few weeks ago. But Mark Carney has signalled that this is less likely following a number of poor economic figures, including the UK services sector from last week, which recorded the 3rd lowest level of business activity in firms since the EU referendum in 2016. Many analysts believe that a rate rise is now more likely next month at the very earliest. It's also important to look at how many members of the Monetary Policy Committee vote in favour of a rate hike to get an idea of future likely interest rate direction movements. By referring to the minutes, we can also see the positions that individual MPC members hold and what was discussed. For example, it was only once the minutes for last year's June meeting was published that we found out that inflation was expected to be higher than 3%. At the time, the market saw this and the MPC vote as a sign that interest rates would rise, as they did in November. Governor Carney's speeches or statements to the media are most closely watched and reacted to by the markets. Again, in June last year, the bank governor stated in his Mansion House speech that now is not yet the time to start raising rates. And then the value of the pound dropped to a 2-month low immediately afterwards. These factors have an impact on currency pairs, particularly involving the British pound. So what happened last time in March? Upon the announcement that interest rates would remain the same on March the 22nd, we can see that the GBP USD currency pair grew by almost 1% in the days following. The red line signifies the announcement, and you can see the reaction on the graph. Markets were unsurprised by the expected interest rate freeze, but sentiment on the pound in this period was more positive due to the Brexit provisional agreement reached between the UK and the EU. You can also see here the euro-dollar currency pair, which increased by 0.4% in value for the same period. The markets had already expected interest rates to remain unchanged. But, as I said, the transitional EU Brexit agreement was giving the pound legs. So what are the prospects for an interest rate rise in the short term? Most analysts believe that there will be 1 or perhaps 2 hikes this year, although less believe this now. However, it's now unlikely that we will see an increase this month. Some analysts believe that the bank might raise rates to 0.275% in June if there are stronger indicators, but most don't. Other economists say that low wage growth and weak consumer confidence should keep a rate rise on hold until the economic situation improves. So what does this mean for us who trade? Well, with the prospect of further rises in interest rates, many analysts believe the currency's post-Brexit lows are in the past. However, recent poor economic performance by the UK, coupled with existing Brexit problems on agreement concerning the customs union border with Northern Ireland, is putting the pound under pressure. Brexit generally remains a negative influence upon indicators and the markets. For the pound to rally, markets will need to see a concrete trade agreement with the European Union and a solution to the Northern Ireland issue. This seems unlikely in the short term. For now, the British political class does not have a united vision of what kind of Brexit they want. However, as I said, positive economic news for the UK in terms of economic growth and the other indicators could see a rate hike at some time later this year, which should lead or might lead to the pound recovering some of its value. A higher inflation rate put pressure on the bank to increase rates too. Analysts agree that a trade agreement with the EU is a hugely important factor to regain the confidence of the markets. In case you missed the promo code during the presentation, this is your opportunity to take advantage of our special offer, which will last for 24 hours. The promo code is FTD1X. Again, we feel it's a great option to use our special offer on the MPC meeting or trade using one of our market opportunities, but the choice is yours. And we at ForTrade will be following any developments that affect the markets very closely. So please do get in touch with a senior account manager if you have any questions or want to take advantage of the trading opportunities that this event will present. Until then, goodbye, and please join us again at ForTrade soon.